Let's talk more about the markets and the possible impact from geopolitical issues. For that, we have Lee Cooperman, Chairman and CEO of Omega Family Office. Lee, great to have you with us.
Thank you. Nice to be with you.
Where are we in the markets in terms of the macro? There are concerns about the impact of tariffs on the economy. There's concerns about inflation maybe picking up with a hotter than expected CPI print last month.
Let me kind of explain things. I'm 82 years of age. I have some health issues I'm dealing with, and I'm not looking to get rich. I'm looking to stay rich, and I don't like the environment. I don't like what I see, and it's very confusing, you know. And I work very hard for two reasons. Number one, I want to be right because I have an ego like everybody else, and number two, all my money I've worked for all my life is earmarked for charity. I like to have more money to give away. So I'm very focused on things, and you know, the president is on the right track, but I think he's doing things in a manner that is very destabilizing. So I have a conservative view. I don't like the action in gold. We're in the 97th percentile of valuation, and he's trying to change the whole ethos of the country. You know, I look at the Statue of Liberty. I think the message at the base is give me the poor masses the earning to be free. You know, and you know, we're rejecting that now, and we're taking a different approach. I understand what he's doing. He's focusing on the deficit, but which has to be focused. But you know, focusing on the deficit is contractionary. You know, there's been a number of companies that benefit from the substantial deficit we've run in the last number of years, and the desire to eliminate that deficit, which is the right thing to do, in my opinion, is going to create contraction.
In terms of being conservative at this point, Lee, what does that mean in terms of allocation?
Well, I think the market multiple is too high. You know, I look at the world and I say, does the stock market deserve to be 23 times earnings, which is about where it is? And I say no. And so I'm looking for things that are selling at a discount to a market multiple and have growth prospects comparable to the market. So, for example, things that we like, Apollo in the energy transfer yielding close to 7%, selling around 11 times earnings. Relatively new name for me, Fidelis Insurance. Book value of 30, stock price of 14. Buying back stock. They're an insurance company. You know, in a hard market, they should be able to earn 20% on equity. It's $4 in earnings. The stock is 14 and change, so it's less than 4 times what I think they earn. So I find a number of things. Lithium Motors in the car dealership area, very cheap stock.
In terms of Vertiv is also one of your top holdings, and I thought that was an interesting one. That's, you know, the cooling for data centers, artificial intelligence play.
We bought that at 10th of the current price. You know, we're holding on, but you know, we pay taxes, so we're not looking to create tax liabilities. You know, we're a taxable investor, so we invest, we don't trade. But, you know, for new money, I don't think we'd be putting new money there.
Is there something that happened in the AI trade that's changed it, or is it just the tremendous run it had until, you know, the end of January or so?
You have a contrarian bone in your body. Every third word on TV is AI, AI, AI. You either get the position it's been discounted or it's not real. So I take the position that it's been largely discounted. And I think it's a positive, no question about it. It's going to raise productivity. But I think, you know, it's already been discounted. So I have a very cautious view of the world. I don't like what I see going on.
Right. You said you're managing most of your money for charity. I'm wondering, do you have a cash allocation since you're so concerned, at least near term? It sounds like longer term, you think, you know, the administration may be on the right track, but shorter term, it's creating a lot of volatility. So what are you doing to weather the shorter term? Is it only just, do you still have most of your money in equities, or is there another allocation to treasuries?
I think short-term cash is competitive these days, yielding 4 or 5%. And I would say that I have a very negative view of bonds. Bonds don't make any sense to me at 4.2%. And I realize Scott Bessent, who's a good man, you know, he's basically talking about 2% bond yield. I don't get it. I don't see how. You know, every day I'm seeing more CapEx being announced in this AI area. There'll be big demand for money. We have guns and butter policy in Washington. So I think the rates are going to head up in the long end, and the Fed can cut them in the short end, but I think the long rates are going to go up. So I don't like bonds. Just one thing your viewers should keep in mind: the only way bonds adjust to higher inflation is the decline in price to keep the coupon current. Stocks adjust to inflation by raising selling prices, which lift a nominal level of revenue and earnings. I'd rather take my chance in a stock than a bond, given everything I see.
So your view on the long end of the bond in terms of yields going higher, what is that going to do to the market? I mean, that's going to be a cap on the markets, I assume?
Yes, I would say so. The stock market doesn't have any equity risk premium currently. And so if rates go up, I think it's going to become more negative for the stock market.